Dell Technologies Inc. ticker symbol DELL is currently trading at $124.75. It is up almost 5% on the day, although down a little bit after hours. But this stock has been on an absolute tear over the last year, up 83%. What we're going to be doing today is talking about the stock and then going to my automated stock valuation spreadsheet to see if DELL is a buy or a sell, looking at the company's financials and seeing if it is a buy using discounted free cash flow model, comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So as I said, this stock has been on a tear this last year, up to all-time highs of $179, but is down about 30% since that time. If we go over the last 5 years, this stock is up 390%, which if we compare to the S&P 500 over that similar time, it is easily beating the market, 391% compared to 94. So let's go to my spreadsheet here. If we put in the ticker DELL, what this will do is it will load all the latest company financials, and then we can have a deeper look at the stock. So currently $126 a share, market cap of around about 88 billion. PE is incorrectly marked as a 0 here. This is coming from Google Finance. But the PE is actually around about 23 with a market average of 29.9. That is lower than the market average. Earnings per share $5.91, and beta not loading as well, which is interesting for Google. Google Finance are not giving me the good data here, but we do have other data. Target price $146 a share, meaning it is a buy according to analysts, which is good to see. Dividend yield of 4, that would be very nice, 1.48%, which gets you around about $1.87 a share. Payout ratios are higher than I would like to see, 82 and 98%. They pay $3.3 billion in dividends, and if you want to get paid by the dividend, what you need to do is buy your shares before October 22nd. So let's have a look at the revenue numbers. Revenue is currently at 91.84 billion. Slightly up from 2024, but down from the highs of 22 and 23, which was 102 billion. Net income, similar story, not all-time highs, but at around about 4 billion, which is excellent to see, increasing over the last 2 years. Free cash flow, I probably expect to see this down. You can see normally looking at the dividend, it would be safer if they're at this 5 to 6 billion. But currently at 3.36. Shares outstanding, they are buying back shares. You can see they've steadily bought back shares for the last few years. And if we go back to the stock price and look over the last few years, buying those shares back when it was $20 and $26, even up to 50, 80 here, because it is currently at 126. This also suggests that DELL thinks their stock is undervalued, and they were obviously right. Assets versus liabilities. Liabilities are coming down and assets are down a little bit as well, but overall looking good as well. So let's get to my discounted free cash flow model. What this is a way of valuing the company based on its future free cash flows, estimating them down to today's value. So if we look at averages, it currently gives us a price at $88. So let's have a deeper look at these numbers and see if we agree. We're estimating quite small growth here, 0.69%. Let's compare this with what analysts are saying. Analysts are expecting quite high revenues, actually, 98 and 105 billion. So let's get something a bit more closer to that. Let's do, oops, can't type. Yeah, if we do about 8% growth, that brings it to $116. Net income margins, I would say, are increasing. So I'm going to bring this up to about 4.32. Puts it at $128 stock. And yeah, net income to free cash flow, I think it's probably going to be higher numbers to what we've seen here. If I take 2023 number, for example, this will put it at $146 stock. So I think discounted free cash flow model does say currently it is a buy, or it is at the very least fairly valued. Right, guys, if you're interested in my Patreon, links are in the description. This is the automated sheet you're seeing now. So now we're going to move on to the comparable company model. This is a way of valuing companies, looking at similar companies in same industries or of similar size. So a few that jump out to me at the minute is, I suppose, Microsoft. Obviously, they're a bit bigger, but I want to compare them in there. Actually, what we'll do is we'll go a bit smaller first. We'll do IBM, HPE, and Oracle. And what this will do is it'll load the company financial data for these other companies, and we can have a comparison. Okay, HP is a bit smaller, so I think that's probably not a good comparison, but we'll have a look here. So revenue, Dell is actually the highest revenue. They all have negative growth apart from Oracle. Net income, 4 billion, 8 billion, 2 billion, 11 billion. Profit margins is actually quite low in comparison to the other companies here, 4.23%. Price to sales, which is, this is the average of the current price to sales, is currently at around about 3.0. Dell is under that with 0.92. Price to book, average currently around about 5, and Dell is under that once again. Next is the PEG, which is price to earnings growth. That is Peter Lynch's formula, and one is undervalued by his metrics. So that is actually very good to see. If you can look at Oracle, HPE, and IBM, they are a lot higher, 2 and 4. EV to revenue, EV to EBITDA, and PE. Then this will give us our calculation. So in terms of EV to revenue, it gives a value of around about $200 a share. EV to EBITDA, very, very low, $60, and PE is $60 as well. So that puts it at $104 stock. If I was to compare it to, let's just say, let's change out Oracle for Microsoft, for example. This would bring it up because you can see the PE ratio. So really, EV to revenue is probably the best one for looking at this. I would look at the dividend discount model, but Dell only has we have dividend history up from 2022, so we basically can't do this. In a few years, we'll be able to use this, but currently we can't now. And finally, the Ben Graham formula for intrinsic value. This is a way of valuing stocks made by the godfather of value investing himself, Ben Graham. What this does is it looks at the earnings per share, the PE for a no-growth company, the average bond, and then the current AAA bond yield, which is currently at 4.87%, unless it's changed. No, AAA corporate bond, 4.87. And I think we didn't see what our analysts are expecting for growth. Next 5 years, around about 11%. So is this a buy? I don't know why it's green. It shouldn't be green. But no, it's not a buy. $95 a share with the price of being around about 120. Obviously, we need a bit higher. So if they were able to grow at about 17%, then that would be a buy. Although if I do look at the AAA bond yield, it is starting to decrease. So if it gets back to, let's just say they have that 11% growth, 4, it would be 116.3. If things are less inflationary, then it would be a buy on this as well. I don't know why the share price is showing the wrong number, but I will fix that. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.